Cool. Okay, so could you all just give a brief background on yourself and then talk about what you're working on? I think maybe not everyone knows exactly the products that you're building. Nadav, could you start?
So my name's Nadav. I'm the CEO of Dharma. Dharma is the easiest place to save in dollars from anywhere in the world. You can think of us as living kind of at the application layer and creating like a simple, intuitive way to access yield in DeFi protocols like dYdX and Compound. Our priority is kind of creating what you could think of as like the Coinbase of DeFi, something that's easy enough to introduce your friends and family to. And that is launching publicly tomorrow. Fun fact. Other than that, I can talk a bit about like our past as a company. There's a whole story. We've gone through a whole path there. We've started off being protocol purists and then being both a protocol and a product, and now we are purely a product. So there's a whole story there, but perhaps I'll save that for another time.
We're curious, but I'll ask later. Antonio?
Hi, I'm Antonio. I'm the founder of dYdX. dYdX is a decentralized exchange for margin trading, borrowing, and lending. So we're built on Ethereum, run through smart contracts, and basically you can think of us as an exchange where you can trade without trusting anybody that you're trading with. So we've been live on the Ethereum mainnet with our current product for about 6 months now. And have somewhere around $40 million or so being lent on our platform and about $15 million borrowed.
Hi, I'm Robert. I'm the founder of Compound. I started my career in traditional finance or mainstream finance, and I'm happy to be one of the folks here creating the new frontier of finance, which is open finance, or decentralized finance, as you call it. Compound is a money market protocol where all assets have a risk-free equivalent yield that can be accessed at any time. There's no duration, so it's ultra short term. You could earn an interest rate for 1 minute or 1 day or 1 year. And we allow users to borrow from the platform as well. And I have the pleasure of getting to know all of these people, and together we're innovating together.
So for those that aren't as familiar with decentralized finance or open finance, could you kind of compare some of the differences and similarities with decentralized finance and centralized finance, as you guys would call it? Robert, could you start first?
I'll start with the differences because I think they're actually the most interesting. The way that assets sort of are administered and settled in traditional finance, it's very slow and it's very cumbersome. One of the best aspects of decentralized finance, as it's built on Ethereum, and right now the Ethereum blockchain is where the majority of this is happening, but it's not the only place. On Ethereum, some of the magical properties of it are that transactions settle essentially instantly. When you do something, it's done. You don't have to wait a day to find out, whether it worked. Things aren't reversible. Finance happens instantly. It's also extremely transparent. One of the, perks of this is that all transactions are visible to the community. You can inspect and audit pretty much all activity. You can make sure all the books add up. You can make sure that everything is accurate. You can inspect the source code. You can inspect how it works. You can make sure there's no gotchas. And, it's completely transparent versus a lot of the opacity that comes from just traditional offline businesses. And, I think that adds a lot of trust in the system, even though, you don't have to trust the people behind it.
Yeah, that was a really good introduction. I think the main thing I would add is I think personally the biggest advantage of DeFi to me as compared to centralized alternatives is access. So kind of the traditional financial system, as you all probably know, is built up around this really centralized set of intermediaries. So for example, if you want to trade derivatives in the United States, you have to have a derivatives broker that's built on top of a derivatives exchange that's built on top of a derivatives clearinghouse. And all this infrastructure is kind of set up to make it so that it's really hard to access these markets. So if you're like in China and you want to trade like US equities, it's really difficult to do that. Whereas with what we're doing, everybody anywhere in the world can have access to our markets immediately with just an Ethereum wallet. And that's a really fundamental change, I think, in market structure. And I think the main reason actually why decentralized finance will win out over centralized finance is due to liquidity. So all liquidity means is that if you want to buy something, there's somebody sitting there willing to sell it to you. If you want to borrow something, there's somebody sitting there willing to lend it to you. And traditionally, like the markets with the highest amount of liquidity have won out. But you're able to build more liquidity if you have more people with access to your market. And you're already kind of seeing this play out with centralized cryptocurrency exchanges, where there's a real kind of like firewall between the US and kind of the rest of the world. You've seen this with things like Binance shutting off access to its product to US customers and kind of siloing that liquidity off, with BitMEX not being available to US. Coinbase is available in most places, but it's kind of like US dominated. So it's kind of like the US and the rest of the world really aren't kind of trading with each other quite as much on the same exchanges. So it's more difficult to build liquidity from that perspective. Whereas with dYdX, we're available to everyone everywhere in the world. So I think that that's probably the main reason why I'm personally excited about DeFi and the possibilities of building liquidity there.
So yeah, these are really great answers. The only thing that I'll add here to save from being redundant is, I think Antonio approached this question from the standpoint of accessibility, and I do think that that's kind of really the killer feature of DeFi. And Antonio kind of highlighted accessibility in the context of trading in the sense of kind of like finding counterparties and being able to like access relatively sophisticated financial products. But what I would highlight is that I also think there's tremendous potential in DeFi for just giving really traditional retail investor products a much more globally accessible reach. So basically, you're talking about taking all of the properties of something like Bitcoin, where it's censorship resistant, where it's usable anywhere in the world, where there's low settlement times, et cetera, and applying it more broadly to retail products like savings. So for instance, on Dharma today, by nature of our leveraging protocols like Compound, you can earn an interest rate in US dollars anywhere in the world. If you're in China, if you're in Argentina, if you're in Zimbabwe, whatever, you can get a stable coin, deposit it into Dharma, and then it will start to earn interest using the underlying Compound protocol. And fundamentally, that's something that's enabled by cryptocurrencies, because there's something subversive about this, right? Like you could never build that on top of the traditional fiat rails. The banking system simply is not wired to do that. It is not incentivized to do that. Countries don't really want you to flee their capital. Like they don't want you to do this. So inherently, DeFi is using the subversive nature of cryptocurrencies in order to provide broader access to financial services. And I think that's why it's really exciting.
Awesome, thank you. So I think a lot of people are curious, who are the actual users of DeFi right now, and what are the use cases? And have there been is there anything like particularly surprising or interesting use cases that you've seen so far? So Nadav, could you start?
Yeah, I mean, so a big reason that we sort of shifted the locus of what we were working on was that in the original version of Dharma, we started to notice that though the majority of our users were just cryptocurrency enthusiasts, like the stuff is still relatively hard to use, and so the majority of people are just kind of like crypto nerds like us. There were a handful of people who we would ask kind of like, why are you using the product? And they would literally say, like, I am an Argentinian and I do not want to save money in pesos in my like local bank that I can barely even trust. I want to save in the US dollar. And that was like this crazy aha moment for us of like, holy crap, like we've been talking about banking the unbanked in crypto for like years now. And now we're actually seeing normal people do this. And so to answer your question more broadly, at the end of the day, right now, the majority of people using this stuff are crypto enthusiasts. No question about that. But there are green shoots of people that are normies, people that are just hearing about this stuff as something that solves a problem for them and not just as an intellectual curiosity. And our hope at Dharma, and I think more broadly in the DeFi ecosystem, is that DeFi is going to be the thing that introduces the next however many people to crypto, not as a vehicle for speculation, but as a vehicle for saving and financial services. So
everyone you see up here is building lending protocols, and there's a reason for that. The main users of DeFi to this point are two different things. So there's lenders on the one side, and Nadav did a really good job of explaining this, just kind of people who want to earn like passive income on their crypto holdings or may not have access to high quality interest rates through their traditional financial products. But then on the other side, the people that are actually borrowing are by and large margin traders. And these are people that are oftentimes speculating or trying to hedge on cryptocurrencies. By far the dominant use case for cryptocurrencies to this point in general has been trading or speculation. I mean, that's why you've seen all the billion-dollar companies be literally exchanges. So like Binance, Coinbase, BitMEX. And I think that has really carried over into DeFi at this point. It's not kind of totally reinventing the wheel. It's just like similar people who are using like those types of centralized trading products are now starting to trickle into decentralized trading products. And I think the reason that lending has taken off is because it's been able to connect these two like really disparate groups of people in terms of just these simple lenders who want to earn interest, these borrowers who are really sophisticated, who are trading. Those people don't often come to the same platform to do that. But DeFi has been able to build products which are very useful to both of these types of people.
Yeah, to add on to that, I mean, we're creating essentially global financial markets. And there's a couple other classes of users that are interested in this. We see a lot of interest from decentralized teams that are, let's say, borrowing a stablecoin to make payroll to teams and developers all around the world. And they find that quite useful. And we've seen a number of mining companies located all around the world using, protocols like Compound, both, as a source of return on their idle assets, as well as to borrow working capital without having to sell off the mined assets. Margin trading is a very popular use case for all of decentralized finance. When you ask what are the users, it's a lot of people who want to be able to trade at 2 a.m. when financial markets aren't generally open, but they are always open on DeFi, 24/7, 365 days a year. And there's a lot of, speculative use cases, and there's a lot of turnover from, semi-professional and, semi-sophisticated people looking for more sophisticated financial products.
So I'm curious to know, what have been the main challenges about building in DeFi, and is there anything that you feel like is missing right now or could be significantly improved in order to bring in that, mainstream use case of hopefully bringing in some people who are unbanked? Nadav, could you start?
Yeah, so again, I think you should always temper my biases here because I'm kind of operating at the application layer on the supply side. So the challenges that I face are very different than the challenges that Antonio and Robert are facing. But we're all kind of in the same boat. So I'll speak to the supply side, kind of consumer-facing challenges. Stablecoins are a nightmare to get into. The user experience for going from fiat cash into stablecoin, even in the United States, is still absurdly clunky. And the third-party providers, though they're getting better, aren't kind of fully there yet. And so I would say, frankly, that's the number one challenge that keeps me up at night is that it's just really hard to get your fiat cash into stablecoins, and to do so in a reliable manner. So yeah, that's a lot on my front.
Yeah, there are a bunch of different things. I think maybe the thing I'll talk about is some of the engineering challenges that make building DeFi protocols and applications really challenging. So kind of starting at the bottom of the stack, as you all know, all of this DeFi stuff is built on smart contracts, which are just programs you can write that run on the blockchain. And this is a really, really cool paradigm because now for the first time in history, basically, you can write programs that execute deterministically and verifiably. If you write a program on AWS, you kind of have to trust them, or you have to trust Coinbase running on AWS to run your program correctly. Whereas with DeFi, everybody can see that this program is going to execute the way the code says it does. And that's awesome, except if your code has a bug in it. And you've probably seen, news of hacks for various smart contracting platforms. So worst case, if your code has a bug in it, somebody can steal literally all the money in your protocol. And that just makes it so that you simply cannot make a mistake if you're writing smart contracts. And it's really, really, really hard to just in software engineering to write code without bugs in it. So that just means that you have to take security really seriously. You have to move a little bit slower. You have to spend a lot of money on audits. And that makes it really tough to build a startup. Because the way you build startups is not that you have some magical vision for like how the world's going to be, and then you go out and build that thing that's going to make this vision become a reality. It's that you build something, you build the wrong thing, and then you iterate and build something that's slightly more right. And then you keep doing that. But it's really difficult to iterate if you can't change things quickly. So just kind of being in this system where you simply can't make mistakes, and you just are a startup, of course, so you need to iterate quickly, I think is a really big challenge. And it's something that you really need high-quality engineers to be doing. You need high-quality people building these things. And I think that's one of the reasons why it'll take a little bit longer for some of these products to be able to get through the necessary number of iterations to build a really high-quality product. And that's been happening over the past couple of years. And now we're getting to the point with things like Dharma and Compound and dYdX, where we're kind of seeing some of these real first use cases of actually useful products that are being built on this infrastructure. But I think it does take a little bit longer for some of these things to be built.
So I'll talk about one of the subjects which is generally taboo to talk about in decentralized finance, which is regulation. I think one of the largest challenges is that these are new financial products and financial markets that are being created that don't necessarily fit into easy to understand regulatory frameworks. They're new, and there's extremely clear virtues to DeFi. It's transparent, it's more fair, it's more auditable, it's less likely to support nefarious activity, but financial products and financial markets are generally highly regulated activities. So even though I think fundamentally decentralized finance has all of the things that regulators generally look for, it's new and it's hard to understand. And one of the hardest things to do in this space is to make sure that what you're building fits in to the right framework, such that it can become a part of the larger global financial system without it being cut off at some point. And it's at a very early stage for, I think, a lot of this space, but I think it's going to become a larger and more important piece of the conversation.
Yeah, I'm glad you brought up regulatory because I feel like not many people talk about that topic. One of the biggest criticisms of DeFi is that it's actually not very decentralized, and the word DeFi is decentralized. So what are your thoughts on that in general? And is there like an eventual goal that it becomes more decentralized, or do you think it already is decentralized? Robert, could you start first?
Yeah, so at Compound, we practice what's called increasing decentralization, where, Bitcoin was magical and special because it was essentially created out of thin air. Nobody knows who Satoshi was. It happened relatively quickly. It took a long time to get off the ground. Most of these decentralized finance products and applications today are built by teams. The way that most teams organize in 2019 is they form companies, they band together, they raise money, they have payroll. And it typically starts off as a seed from being a very centralized activity. A lot of people are metaphorically in the same room building something together. So I think no matter how decentralized something becomes, right now it's generally starting off being built by a centralized team. So at Compound, we start off with the idea that everything begins centralized, and the goal is to have complete decentralization, where eventually the team has no role, no responsibility, and no involvement whatsoever with the product. And it's a spectrum. It's not binary. It's a gradient. And it starts off centralized and eventually becomes completely 100% authentically decentralized and uninvolved. And every step along the way is a progression towards that complete decentralization, where the team can be hit by a meteor and everything functions completely flawlessly forever.
Yeah, I think Rob brought this up, but one of the things that you have to realize with decentralization is a spectrum. It's not binary. So I think the ways I would classify cryptocurrency products are, on the one side, you have completely centralized or custodial. So if you use Coinbase, they're literally holding your private keys. They can do whatever they want. The next step kind of along the way is non-custodial. So maybe everything is not entirely decentralized, but at least it's non-custodial. So you kind of control your keys. You're the one sending the transactions or signing the messages that make the things happen on the blockchain. And it's auditable. You can see what's going to happen. Maybe the team team's not decentralized. Maybe they're running their website on, they have servers on AWS, so there's some kind of like centralized architecture, but they have put like all these safeguards in place such that you can trust that what they're doing any actions that they take have to have your consent before you do them. So I would define that as non-custodial. And I'd say non-custodial is basically where all DeFi products are right now. There's like a little bit of a spectrum in terms of like which ones are more decentralized or less decentralized, but any decent DeFi product is probably going to be in the non-custodial realm right now. Then in the far right, there's fully decentralized products. And I would say that these don't really exist yet outside of kind of base level cryptocurrencies, maybe like Bitcoin. Even Ethereum, has like the Ethereum Foundation, so is somewhat centralized in that regard. There's a lot. It's really, really difficult to do that, and I would argue it's straight up impossible to build any product that's completely decentralized right now. Just like a lot of really difficult things like governance, like decentralized, building decentralized code, like serving decentralized applications to people, running decentralized code in a scalable way. It's just literally impossible right now. So you kind of have to temper your expectations, but living in the real world, kind of building products that people want to use right now, non-custodial is a real step up from centralized, and that's kind of the world we're living in. I totally agree with Robert in terms of like these things have to start centralized. Like I said, it's just literally impossible for us to build a fully decentralized application right now. But I think the ethos of the space is such that the really high quality teams have this in mind, and they do want to make their products more decentralized over time. So I think it'll happen. We've been making good progress so far. You just kind of have to temper your expectations, like given the state of the technology.
So yeah, I mean, the 2 points that I would make is, first of all, I really dislike the term decentralization because it is a conflation of multiple value props. As kind of Antonio phrased, like there's one value prop, which is the idea of like non-custodialness, or what I would like to call like, can't be evil. Like the application you're using can't be evil, even if it's compromised in some capacity. And that's one really big value prop. And frankly, like I think they would agree as well. Like if you talk to the users of DeFi right now, the vast majority of people care about non-custodialness and non-custodialness alone. That's the only thing that they care about in terms of the subsets of decentralization. And then there's kind of like this like censorship resistance kind of political decentralization component, where the value prop there is about like, we don't want to have any government be able to step in and censor transactions. We don't want too much power to be concentrated in the hands of one actor, et cetera. And that's a very different value prop than just non-custodial aspects of these products. And so really, like I think that like in many ways, like the debates that happen around like decentralized finance are a little bit semantic, where really we're like kind of like we're arguing about like this kind of loaded term that encompasses two very different value props that right now like are serving very different user bases. The second point that I would make is that regardless, though, I think Antonio made the point that like the best teams in the space are like thoughtful about moving towards more political decentralization, so to speak. And frankly, it's that isn't even necessarily a decision. That's more of like an evolutionary pressure. like the nature of the DeFi space, by nature of like the regulatory environment, kind of pushes you into one of two extremes. Either you're going to be a centralized company and you're going to own the stack and you're going to have big old legal teams and you're going to have a compliance team and deal with all of that stuff, or you need to go as far as possible to the other side and basically say like, try as much as possible to divorce yourself from the stack, try as much as possible to make it so that there's no humans operating this thing but code. So the last comment that I would make is that like, it's kind of like the natural trajectory of DeFi will tend towards both decentralization on one side of the spectrum, but also logical centralization at the point of products.
So do you guys think that we should not have the term DeFi?
Nadav created
controversial.
Yeah,
Controversial.
'cause the fact that you don't like that word and you named it.
Yeah, so you know, I would say that like catchiness is a value prop that is separate from semantic meaning, and I would say DeFi is too damn catchy to tack on at this point. So that ship has sailed, in my opinion.
Really? Okay. So right now it seems like the vast majority of DeFi is captured on Ethereum. Do you think that's going to remain the case, or do you think that there's other smart contract platforms that's going to also have DeFi? How do you think about it? Antonio, could you start first?
Yeah, for sure. So if you want to build a DeFi product right now, there are a couple different things that you need to think about. First is on the engineering side. So like I was saying, it's really, really difficult to build these products, really difficult to build smart contracts, test them, all this stuff. And the thing that people don't realize about software engineering is that software engineering is a stack. So maybe for the blockchain, you have like the base level blockchain that you're building on, which is just the first thing that you need. The second thing you need is a programming language to build smart contracts in. Ethereum has this language called Solidity to do that. And it's getting better. I'd say it's decent at this point, but it doesn't stop there. You need tools to be able to test your smart contracts, to be able to kind of build your smart contracts efficiently, to compile them. Then you need tools to be able to, ship your smart contracts to your production code, be able to like bundle them into your production dependencies, all this kind of engineering stuff that you need to do. And all of the other blockchains right now, even if they have maybe a base level blockchain that you can theoretically build smart contracts on, they don't have all the rest of the stuff. So it's literally, it's not impossible, but it's extremely hard to build a high quality product on top of those other blockchains because they just don't have the engineering infrastructure built up to be able to support that. And that's something that's really important. The second thing I would say is that if you are an exchange or you're a lending product, you need things that people want to trade, or you need things that people want to lend. So the really cool thing about Ethereum is that there's lots of assets on Ethereum. There's Ethereum itself, there's all these ERC20 tokens, there's a bunch of stable coins that people are making. And natively on Ethereum, you can use all of these assets basically immediately. It's really easy. The thing that's become really hard in cryptocurrency is to move across blockchains in a decentralized way. It's basically like an unsolved problem at this point, though some people are working on it. So you need to build on a platform, a blockchain that has a lot of assets on it. So maybe you could build dYdX, or you could build Compound on EOS, and maybe you could make exactly the same product, and it would be like just as good, and probably nobody would use it because like, okay, maybe you can use EOS. I don't know if there are stable coins on EOS, but like probably there's no assets that people want to trade there. And I think that that's a really, really strong network effect that all these other blockchains are going to have to overcome. So it would really take something that truly is 10x better from an engineering perspective to be able to beat and kind of supplant Ethereum. And that definitely hasn't happened yet. Maybe it will in the future, but yeah, I don't see any evidence of that happening for now.
I can add some comments there. So yeah, definitely would underscore the fact that like you just need stable coins and tokens. Like that's like I think everybody on the stage has probably been approached at one point or another by like the next gen blockchain developers to court us to like build on top of them. And super open to that, but at the end of the day, it's a non-starter if there's not like a stable coin and other assets on there that can like be used as collateral or as a a trading pair or what have you. The other thing that I would add is that the main selling point of most next-gen blockchains is scalability, but like layer one scalability. But it seems like pretty much all of them are taking on various flavors of sharding as a method of doing that. And the tricky thing about sharding is that it's not kind of like this silver bullet that like solves DeFi scalability. I won't get into too much of the technical specifics here, but basically, like, even in systems like ETH2, it's very likely that like DeFi protocols that are highly trafficked are nonetheless going to need to like create like very sophisticated layer 2 systems in order to make these things scalable. All of which is to say that like the L1 scalability benefit is material, but doesn't like completely solve your problems as a DeFi protocol. And so that margin of difference between these next gen blockchains and Ethereum is perhaps less wide than a lot of people assume.
I also had a question around metrics. So right now, a lot of people are paying attention to like ETH locked up in DeFi. Do you feel like that's an appropriate metric? And even if so, like, are there other metrics that you guys are really actively paying attention to?
So ETH locked up in DeFi was basically one of the first metrics to get created for it. And, you know, there's weird traditions, but like the first metric wound up being somewhat adopted by the community just because it was the first standardization to measure many different projects. Although it's probably not the right metric. I think at the, you know, in a distant future, you know, if you were measuring any type of financial product or financial application, you wouldn't measure, you know, how many assets are being used as collateral or locked up in the system. You'd probably measure things like, you know, customers or revenue or, you know, turnover or whatever you would imagine. So I think it's a funny metric. I don't think it is how we're going to measure projects in the future. I think, you know, eventually DeFi is going to look a lot more like finance. If you were measuring exchange, you might measure, you know, transaction volume or, you know, commissions or something like that. You wouldn't measure how much collateral is in the exchange.
Yeah, I agree with everything Robert said, except I'm going to come down a lot harder on this. I think ETH locked in DeFi is an extremely stupid metric, and I really wish people would stop judging and ranking big protocols basically based off of it. You know, there are some like really great protocols that have 0 ETH locked in DeFi, like 0x, for example. They do like quite a lot of trading volume, but just the way the protocol is set up, like you literally don't need collateral to use it. So why are we judging people like based on like how much collateral they have locked up? I think you need to take a look at like more interesting and relevant metrics for each particular type of product that's being built. For I guess at least Compound and dYdX, the one I usually look at is loans originated, or kind of the volume that's being originated day over day. So that's the main metric that I look at. And also the way that both Compound and dYdX work is that having more collateral in the system is not necessarily it's not necessary to be able to like borrow based off of it. So the way that both of our things work is you have these markets where kind of some people come and lend to the market and some people come and borrow from the market. So you can have a market where, say, like $2 million is being lent and $1 million is being borrowed. That means there's only $1 million in the system. Or you could have a market that's like $100 million being lent and $99 million being borrowed. So it's the same amount of money locked up, but clearly the second product is way more valuable than the first product. So yeah, I think it's a really stupid metric. I wish people would like start actually looking at the metrics that really matter.
Yeah, so yeah, I mean, I completely agree. ETH locked in DeFi is a metric that is taken from the standpoint of Ethereum investors who are thinking about supply getting taken off the market, and not necessarily a good calibration of DeFi's adoption. It celebrates capital inefficiency. It's pretty silly. That being said, it's kind of hard to come up with like an apples to apples, like one metric to rule them all for all these different decentralized financial protocols. As Antonio kind of pointed out, for instance, like the metric that makes sense for 0x is probably transactional volume. The metric that makes sense for Compound is probably the size of the markets. The metric that makes sense for dYdX is potentially a combination of transactional volume and like loan volume and things like that. One thing that I would propose that I think I would like to see as more of a metric that's used in DeFi, because I think it encompasses what is like currently one of the biggest drivers of demand in DeFi, is interest generated in DeFi. And what I mean by that is that interest generated is agnostic to loan duration, loan size, to the kind of amount of collateral locked up, whatever. It's literally just capturing how much are demand side users, aka borrowers, willing to pay for this thing, and how much are they paying for this thing. And I think that really helps make that's the closest thing in my eyes to like an apples to apples comparison of like dYdX and Compound, for instance, that isn't distorted by a variety of other metrics.
Awesome, thanks. So before I open up to questions, just one last thing. Are there any like trends in DeFi or things that you're really excited by that people should be paying more attention to? Probably very focused on your own protocols and products.
Yeah, I think very focused on our own protocols. One thing that I've kind of seen more broadly is that there's not like that much new stuff happening, but there's some amount of consolidation, I think, happening to the actually good products and actually good protocols that are being built. So, MakerDAO's become really popular, Compound's become really popular, dYdX has become fairly popular. And those are the teams that actually know how to build products, actually have good engineering teams and all the rest of this stuff. And kind of a lot of the hype, I would say, around ridiculous token projects, or even slightly less ridiculous token projects that just don't have the teams to be able to compete with, legitimate Silicon Valley and other companies are kind of slowly falling off. And we'll see more of that, especially, I think, as some of these teams start to run out of capital because they can't raise more money. So I think that'll continue to be the case for the next couple of years. Maybe there'll be another wave of really interesting innovation happening at some point in the future. But I think for now, at least, it's kind of been a little bit of a consolidation to the higher quality teams in the space.
So one of the things that's changed in DeFi is that when it started, there was a number of projects, but they were very early on. They weren't well understood. They weren't, fully mature products, and they weren't, able to be used as building blocks for other projects. One of the things we haven't really talked about today is the composability of DeFi. What this means is that, on Ethereum today, if you have a project and it's, it's a tool, anyone else can build a project that makes use of that tool. Someone else's application can be built using multiple products. They can be built using 0x and Compound and dYdX, et cetera. And so one of the things that we're seeing now is there's starting to be these mature building blocks that are able to be used by the next generation and the next wave of developers. And so people are, less focused on building, simple building blocks as they are taking the building blocks that have come into fruition and extending them, adding new experiences, new use cases, experimenting with wild ideas that you wouldn't have been able to try all of 6 months ago. The pace of experimentation is starting to accelerate again, and it's really cool to watch. I think there's going to be a second generation of DeFi products that weren't possible 6 or 9 months ago that are possible now. And they might be much more impressive than any of the things on stage, just because, when we started, none of this was possible. And so I think the things to keep your eyes on are the projects that are just getting started, that are trying really radical things. Now that there's a base level interest rate, a base level trading protocol, base level margin, and all of these things, you're going to see really funky financial products that might actually be even more popular than what exists right now.
Yeah, so I'm going to take a little bit of a different perspective here. So a big thesis of what we're working on is that there's a huge consumer app kind of opportunity here where you can basically have a checking account that pays you and not the other way around. And we're building that. But so are a lot of other people. And since we kind of went out and announced that we were doing this, I can name maybe 4 or 5 different teams that are also building things of a similar flavor. Which to me, mind you, none of these things are really live yet. None of these things have adoption or anything. But to me, signals very clearly that there's this big wave coming in the next 6 months of people trying to take DeFi as a infrastructure layer and kind of compose it into these really neat, beautiful consumer apps that normal people can use. And obviously I hope that we win and that it works. But I think it's going to get very competitive. I think that it is going to get very interesting. And I think that ultimately the users are going to win.
Great. So we'll take some questions from the audience.
Thank you. Great presentation, guys. Really excited about what you're all building. Question for you. I've started seeing a few interesting proposals for rebuilding a lot of key DeFi apps on top of Bitcoin using just HTLCs, multisig. I'm curious if y'all have looked into that and what you think of the technical feasibility and if that's something you would be open to porting to later.
Good luck.
Yeah, so I don't want to come down too hard on this, but my answer would be yeah, no way, who cares? I don't really think that certainly I at least am not thinking at all about that. Maybe if you really care about getting the next level of decentralization, that might be something that is important to users and developers at some point. But like I was saying, right now, even on Ethereum, like we straight up cannot build decentralized apps. So like we can only build like non-custodial apps. So if you're going to kind of take like an even more restrictive blockchain in terms of like the scripting language and what's possible, and I know there's been a lot of like improvements to all of that. It's just like there's not that much like interest or demand for that at this point. I think there's more demand to kind of experiment on like the product side. So I think that's probably where I would guess that all of our focuses are right now. Though maybe there are some teams kind of that are working on more of that like truly decentralized like financial product vein, and maybe that's something that will win out due to like having censorship resistance and like being able to serve everyone everywhere in the world quicker than we can do it. But yeah, that's not top of mind for me right now, at least.
Yeah, I think that like to add to that, like the best argument I could see for why it would make sense to build DeFi products on top of Bitcoin right now is just access to Bitcoin as the asset. Obviously, like if you had Bitcoin as a collateral type, for instance, in MakerDAO, that would greatly expand the pool, the amount of DAI that could be issued. However, I think it is way easier to bring Bitcoin to Ethereum in various different capacities, either through something custodial like wrapped Bitcoin or something more novel and synthetic like TBTC, and to integrate it into existing DeFi protocols and to go the other way around.
So Nadav, something that you've talked about is the kind of inaccessibility to the average consumer of non-custodial wallets. Like the average person is not going to be able to install MetaMask, or at least it's not really reasonable. So what progress do you think has been made in this domain, and how much more progress has to be made before an average person can put their money in Dharma?
Wow, you're really teeing me up here. So we're launching tomorrow with our full product, which includes something that we call the Dharma Smart Wallet, which is kind of an amalgamation of a lot of very exciting advancements that have been made in the non-custodial wallet space over the past year. And basically what this is a non-custodial meta-transaction wallet that you can use directly in your browser without installing any sort of Chrome extension, that supports multiple devices at the same time while you can keep the same address, and where you don't have to pay any gas fees or store seed phrases or do any crazy stuff. You literally just sign up with an email and a password, and your keys then live on your device. I'm not going to act like we like solved the thing, like it's fixed. Don't worry. Like there's still challenges ahead, but I do think we've made sort of a step function advancement there, and I actually think that like the making non-custodial products like easy to use part of it isn't as hard at this point. I think the harder part is like literally like getting dollars into stablecoins. Like that's still the giant headache. But stay tuned. We'll be announcing all this tomorrow.
Robert, you mentioned composability as being a really exciting piece here. How concerned should we be about ETH2 potentially breaking some of that composability?
That's a great question. I think it's very early in the R&D process still. We've been talking about ETH2 for almost 2 years now, and it's still 2 years away. I think at this point, a lot of the design conversation comes down to not breaking the things that have been built already on Ethereum. I think that's kind of one of the design goals of ETH2 is to make everything better without ruining everything that's already been created. So, there's still some open questions about, how exactly will ETH2 work. I don't think there's a final spec by any means. Some of the designs will make it harder for applications to interact potentially, but the goal is not to break anything that's already been built. And so it's a big open question.
Yeah, I can talk about this a little bit more from an engineering perspective. Actually, the thing in engineering that's really, really hard is doing things in parallel. And kind of right now, we're actually, from an engineering perspective, in my opinion, living in happy times for Ethereum smart contracts, where if you're an engineer, it's amazing. Like once you get over like the hump of just like learning Solidity, you're telling me everything runs serially, so that just means everything processes like in a row. Everything happens atomically, which is like for payments. I used to work as a payments engineer at Coinbase and then Uber. We could have had like atomic like transactions that would have solved basically like Uber wouldn't need like 99% of its payments engineers, for example. So we're kind of living in like happy times right now in terms of where it's actually, once you get over like understanding the base level stuff, it's really, really easy to kind of build these smart contracts in a way that kind of works. Like you can atomically take a loan on Compound and fill a transaction on 0x in the same transaction. And you don't have to worry about like, oh, you make the loan, but like the 0x trade fails or something like that. So I think like things like sharding are going to make engineering for decentralized apps way, way, way more challenging. And that's necessary. And that's the reason why you see some of these like really successful like traditional companies like Uber. Like why does Uber have like 2,000 or 3,000 engineers or whatever? Because like doing things at scale, doing things in parallel is really, really, really hard. And why can like I start up my like ride hailing app that serves like 10 customers by myself probably like next weekend? It's because of the scalability stuff. So it's like once we start like actually tackling these hard problems of scalability, we're going to need like multiple orders of magnitudes, like more engineers, multiple orders of magnitudes, like more smart people, like being able to work on this stuff, being able to engineer it. So I think it'll be definitely a different time, and it's a very like open question as to like how this evolves. But I think it's going to be like way harder than people think. Like it's not going to be like Ethereum comes out with Ethereum 2.0 and then everything just magically like gets 100x faster. It's like Ethereum 2.0 is going to come out in like 4 or 5 years because they take forever. And then like all of the engineers are going to start like trying to understand everything for like a year or two. And then like it's harder to build stuff. So that's going to take like another year to like build everything. So it's like, I don't know. Personally, I think it's going to take like 5 to 10 years before like real mainstream like scalability type like consumer applications like get built on any of this stuff. But what you can see is you can still build like really interesting applications even if you don't have scalability. Like people are using this stuff today, and like there's a reason that they're using it. They're using it for like higher value transactions. So I think that that's what's interesting now. I think like all that stuff is very far down the line, and it's really interesting to like theorize about like what's going to happen. But if you want to build a product right now, you kind of have to deal with the limitations of like the base level blockchains for a while, I think.
Awesome. We're going to leave it there. Thank you so much to the panelists.